Welcome to Money Talk. I'm Kim Parley. Great to have you with us tonight. We are talking about all things banks today, a checkup, if you will, on the health of Canadian and U.S. banks. Joining me from TD Asset Management is Ben Gossack. He's a portfolio manager for the TD Balanced Growth Fund. It is nice to have you back.
Thanks for having me back.
It is a staple in most people's portfolios, so good to kind of check on how things are going. We've gotten most of the third quarter earnings out. I think we're still waiting on TD, which is expected out tomorrow. But if you were just to kind of back up and say, to characterize the quarter so far, what do you see?
Sure, I think it's been a great quarter. You're right, we've done 5 of the big 6 banks. Tomorrow, TD will wrap it up. I'd say going into the quarter, there are a couple of big catalysts we were watching. One, we had a policy response to slow the housing market down, so we were looking for that effect on the bank earnings. We had an interest rate hike at the Bank of Canada. We were watching from effects from that. We also had a very strong Canadian dollar. But when you look at the 5 banks that reported, this provides us a good sense for where they were. We saw really solid earnings growth, and a lot of it came from their Canadian banking segment. So I think we put together a summary.
It's a very nice summary. And actually, what I want to highlight on this, and sorry not to interrupt, you know, it's like beat, 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 beat. I mean, they're all beating in terms of, well, almost everything. Are they not?
Yeah, across the board, the banks put together a really good quarter. If we had to characterize it, National probably put up the best quarter, and that would be followed by RBC, Scotia, CIBC, and BMO. I'd like to highlight the earnings per share growth on average, about 8%. This is great. 3 out of the 5 banks have raised their dividends. And what's also important at the bottom right-hand corner is the capital ratio. At 11%, this means that the banks have a healthy cushion of capital that support future dividend increases and share repurchases. I think if we look below the earnings per share, going to that Canadian banking segment, you know, forget the fears on a housing slowdown. We saw loan volumes continue to grow on the mortgage side and, more importantly, on the business side. And we saw the beginning of a sort of inflection point for net interest margin.
Right, and explain to people what happened there and why you watched that.
So interest rates have been so low for so long, and it's slowly been eroding the margin that the banks make on their earning assets. That's a headwind for earnings growth. Now that we've sort of hit a bottom, this is really positive and could support, and with further interest rate hikes, this could accelerate earnings for the banks because that drops right to the bottom line.
So with that change in interest rates, obviously led by the Bank of Canada, helps them on a net interest margin basis, also strengthens, we've seen a strengthening not just because of that, because of the Canadian dollar as well. How does that impact the banks? I mean, I know some of them have, you know, big U.S. operations, not so good, I think, from that standpoint, but what impact does it have? Is it how material?
So it does have a translation effect.
Yeah.
A lot of times we do try to look through and see what was the underlying strength of the U.S. segments, and for RBC, we'll find out for TD tomorrow, and for CIBC's new acquisition, they put up really strong numbers on the south of the border. So, and these are growth platforms for RBC and CIBC, so I'd say that's a very positive. I'd say one thing that won't disappear yet will be this fear around housing. So we had a policy response. We've seen numbers tick down. It also comes around a seasonal low period for housing. So I'd say for the bears, it's confirming, but I don't think it confirms anything. I think what tends to get overlooked is just the strength of the Canadian economy. Let
me bring up, you brought another chart here showing Canadian job activity. It's funny, I remember from the years of talking to economists, the one thing that it's always been very salient to me is jobs, jobs, jobs. Housing market will be okay if the job market's okay.
Right, so I mean the most important element for all banks is credit and the health of credit. And so, the biggest concern for banks is a recession. Why do we care about recessions? Because people lose their jobs. They can't support their credit load.
So what are we seeing here?
So what we've tried to do is map out the job gains year to date. And so year to date, so 7 months in, the Canadian economy has added 200,000 jobs. And just to put that in perspective, this time last year, we added 40,000 jobs.
Oh,
so
wow.
a 5x increase. And you can see that it's been spread out across the country, whether it's British Columbia, Manitoba, Ontario, Quebec. Even across the economy, we've seen gains in manufacturing, trade, in the professional services, and in healthcare. And so, yes, we do watch the levels of debt that the consumer is carrying. But because we've added these jobs, and most of these jobs, in fact, are all full-time jobs, people have a steady paycheck, which means they can continue to support their principal payments, their interest payments, and that's why we're seeing credit remain in check for the banks.
A lot of bears generally on Canadian banks outside of Canada. We see a lot of, and they catch a lot of media on that too, being proven wrong, I think, in terms of their prognostications of what was going to happen with the Canadian market. What do you think, or what do you see with valuations with banks over the next little while? Canadian banks have been hit a bit in terms of, I remember when the CBC coverage came out and they talked about some of the issues they had. Have we seen a rebound yet, or do you expect that to come in the next little while?
So I think the Canadian banks are poised to outperform over the long run.
And why is that?
So we've had a bit of a run up in stock prices. We've moderated. When you look at valuations, you're paying around 10 to 12 times, but it's actually quite cheap for what you're paying for. So the banks have sustainable earnings, and they're growing at about 5, 6, 7% in that digit range. You're also getting on average a 4% yield, which also grows 4, 5, 6%. When you add that together for the shareholder, you're getting about a 10 to 12% total return, only paying 10 to 12 times. And more importantly, that's at a deeper discount relative to the market. So in terms of where to park money in Canada.
In a yield-starving environment.
In a yield-starving environment for sustainable earnings, we think that's where the Canadian banks are the place to be.
All right. Stay with us when we come back. We're going to talk more with Ben Gossack. We're going to head south of the border and get his take on what's happening with U.S. banks. You are watching Money Talk.